Okay. Ralph, why is a progressive tax better for Illinois?
Well, good morning, everybody. Ralph Martire, Executive Director of the Center for Tax and Budget Accountability. And for those of you who don't know my organization, we're not nonpartisan, we are bipartisan, which means my board of directors neither likes nor trusts each other very much. And that's a really good thing for the group because it allows us to focus on best practices and data. And so we do not take an ideological or world view to these large problems at all. We take a data-based, evidence-based approach. And so when we look at Illinois, we look at a state that despite having great wealth overall, has significant inequities. And in fact, one of the traditional real problems that government faces is where great needs exist, resources are lowest. Fixing that, creating a finance structure that allows the state to fund core services where they're needed by taxing fairly in accordance with ability to pay, requires taking an approach that looks at how incomes grow and change over time, and how best to tax those incomes to support the level of government that you think the state should have. Now, interestingly enough, Illinois has historically been a very low taxing state overall. We have, until the recent tax increase that was temporarily passed in 2011, ranked in the bottom 6 total state and local tax burden as a percentage of income. Those aren't my statistics. Those are the statistics of the Federal Tax Administration, which just collects the national data and reports it. And interestingly enough, when you hear us talk about data, it's all publicly available data. And we do no unique modeling with proprietary information. We do something called math. We just take the numbers that anyone else can take and apply them to the situation. So what we've seen in Illinois historically is a mismatch between the growth in the state's revenue sources and its cost of providing services from year to year. And to be very clear, we have the 5th largest population and 5th largest economy of any state, but we have consistently ranked in the bottom 10 to 15, depending on the service category, in the service provision, whether it's education, healthcare, social services, or public safety. So we've been a low spending state that has a revenue system that doesn't support its spending levels. So that's encouraged us to do some pretty irresponsible things at the state government level. We have in fact borrowed to pay for current services. And we are in the position now where we're paying that borrowing back. The primary vehicle for the borrowing was the pension system. So when you talk about state spending, what you need to understand is while spending from year to year is increasing somewhat, none of that's going to services. It's all going to paying the debt that covered this imbalance between revenue growth and service cost growth over time. Illinois' tax policy is so poorly designed that in fact, without adding or expanding one core service, Illinois will run a deficit. What we need is a tax reform that takes into account the modern economy and sound fiscal policy. There are 4 principles of sound taxation in a modern capitalist economy. Your taxes need to be fair to people, responsive to the economy, stable during all economic cycles, and efficient, not distorting economic decisions. Illinois is 0 for 4. Now, where the progressive income tax comes in is it will allow the state to comport with 2 of those core principles of tax policy: fairness to people and responsiveness to the economy. Now, why do I say that? If you look at the distribution and income growth over time, you see a dramatic differential between the top and everybody else. So let me give you the data. And this is all culled directly from the Internal Revenue Service, and it's based on actual tax returns that we have filed for decades. From 1947 to 1979, the bottom 90% of America realized about 64% of all income growth. The wealthiest 10% got about 36%. So there was a disproportionate share of income going to the top, even during that economic cycle when a rising tide was pretty much lifting all boats. things have dramatically changed since then. From 1980 to 2010, the top 10% in America have realized 139% more than all income growth, meaning the bottom 90% have seen their incomes decline after inflation by 39%. The only way you could respond to that is to have a tax structure where your income tax rate increases marginally as your income increases over time. A flat tax doesn't respond to that, hence doesn't comport with ability to pay and taxes people unfairly. And to be very clear the way it works, because people don't understand, the marginal rate doesn't apply to your whole income. So under a structure like the federal government has, or 34 of the 41 states with an income tax have, for the first, pick a number, $20,000 of income, you pay X percent, 3%. On the next 10, 15, 20,000, you pay 3.5%. You don't pay 3.5% on the whole thing, right? So it's only a marginal increase on segments of income as income goes up. So the most meaningful comparison when you look at these tax policies isn't the marginal rate at all, because what people actually pay, their effective rate, is impacted by their deductions, the exclusions, and everything else.
Ralph, if I could jump in here, I let you go a little bit longer in your intro remarks because you kind of anticipated one of the questions I had.